Hey guys, Mohan Bear here. Now, I've been working on this roll-up in the last 2 months. A roll-up that I believe we could get to hopefully 10 million in EBITDA until the end of the year. Around 5 million in there and probably 300 million in revenues in the pipeline that we're working on. Now, I don't have 300 million in cash that I can use for this roll-up that I can access you right away, but I'm going to show you how I'm planning to finance it using other people's money. You could potentially use it to your deals. Now, disclaimer before I'm getting started with those. You gotta be good. Like, you gotta have a plan, you gotta have executive summary, you gotta have a team, you gotta have your roadmap, you gotta have a forecast, you gotta have a lot of things lined up to be able to do that. You gotta understand the market opportunity and the total addressable market. You gotta be able to explain why a roll-up makes sense in that sector. Like, for example, that there's a lot of fragmentation in the market, you know, that you can buy them for low multiples and then bring them together and then sell for high multiples or take them public. You also gotta be able to sell yourself on why you'll be a successful buyer in this roll-up. You gotta understand your underwriting process. So for example, what revenues you look at, what profits you look at, what margins you look at. You gotta have a pipeline of deals. Like, we right now have dozens of deals, like I said, more than 300 million in revenues in the pipeline, which obviously means nothing, right? It's just early conversations with those companies, but still, it's something that you can show institutions and investors when you're working on a plan like that. You gotta have a plan, like a roadmap, like a playbook on what you're gonna do after those acquisitions, like what you're gonna do to merge and integrate and create good fundamentals in the business, and how you're gonna make sure that if you're buying 10 businesses, you're not just gonna end up with 10 messy businesses, and how you're gonna integrate, save cost. So it's a different story to do a roll-up versus doing like one deal at a time. When you do your first deal, I mean, there's less things that you need to convince or demonstrate in front of investors and institutions, because in a smaller deal, in one deal, there's less risk to take on you as the buyer. If you're doing 10 deals or 20 deals, then guess what? There's more risk, there's more capital involved, so the due diligence on you is going to be much higher. And then the team matters, then who you have on your board matters. All right, so let me share with you the first way to finance such deals. So first one is enterprise value lending. So what that means, it means that the lender will basically look at the goodwill of the business. He will basically look at the combined group that you have, the overall revenues, the profits, the margins. They'll look at things like patents and trademark and anything goodwill, basically. There are specific banks and institutions that are really, really good at this type of financing, the enterprise value type financing. So what that means, so let's say you have an existing business, you want to buy 10 more companies, right? Let's say each of them is doing 2 million in EBITDA, 20 million in EBITDA total, 10 times multiples of that puts you at the 200 million valuation, enterprise value, basically. And obviously, they'll look at comparable in the markets. They'll look at what other companies at that size are being traded at. But it can give you a quick boost and quick access to high amounts of capital very, very fast if you have the right deals. Now, interest rate is going to be kind of like all over the place, but amortization probably going to be at around 10 to 15 years on deals like that. Interest rate will probably be prime plus 4.25%, at least based on kind of like the latest offers that I got. Now look, it's much more expensive than like traditional banking and whatnot, but in the end of the day, they take much more risk on you, right? So it's something you want to consider. Enterprise value, again, in a nutshell, let me just play with my new settings and show you how cool it is. Let's say you have 2 million EBITDA business. What is EBITDA again? It's basically your pre-tax profits. And let's say you have 10 businesses. You do this, you basically have 20 million EBITDA businesses. And you put a 10 times multiples on that, which puts you at a 200 million enterprise value. You can now raise. That's the game with enterprise value financing. Next one is royalty financing. An institution can come to you and basically say, look, we'll take 5% of gross revenue of your business and we'll take it until we double the amount that we give you. Then after we double our money, we lower it to, let's say, a quarter in perpetuity until the buyer buys the lender. And obviously there's all like clear amortization schedule, and everything is super clear to the details on what you can do and what you can and when you're paying things back. The beauty or interesting part of this is that a structure like this is basically completely off balance sheet. So let's say you get 10 million, 5 million goes into cash and 5 million goes into owner's equity. So it boosts the business right away. There are very few unique and boutique financial institutions that do that, but it's super unique, kind of like a Kevin O'Leary if you follow Shark Tank type of deals, but on a higher scale. And on the income statement, a structure like that, a financing structure like that, going to be under COGS. So it's basically going to be kind of like a commission for sales team that you're paying. That's how it's going to be looking in your P&L. All right, another quick one for today. The third one is SBIC. SBIC is kind of like government-backed as well, but it's a bit different. They have much more flexibility on how they do deals compared to like an SBA, traditional SBA loan. Some do pure debt, but interest probably going to be higher because they take more risk on it. So they might ask for some kind of collateral. They also might do mezzanine and leverage the shares of the business. And there's a chance of seeing offers where they might lower the interest, but will say, hey, okay, so at least I want warrants in the business. So they kind of like mimic private equity, some private equity firms out there, but it's not 100% that. So hopefully it opened your eyes today to some of the opportunities when it comes to financing some of your deals. So remember, enterprise value financing, royalty financing, and SBIC. Those are some structure that most people are just not familiar with, and I think are really, really cool that if you'd be able to get them, will really be able to accelerate the growth of your business. The most important thing you need to keep in mind is do things fast, right? Let's say you sign on a deal, you want to close it in the next 60, 90 days. Something that happens after 60 days, if you're not able to close a deal, there's a deal fatigue that then makes everyone just give up and don't want to close the deal, right? So you never want to get to that. You would never want to get to a point where you're at this situation. You want to push hard when you have a good deal on the table. That's why we introduce some of our institutions to the people that we work with. So yeah, that's it for today. Let me know in the comments below if you like those kind of videos. If you do, I'll do more of those. Yeah, hopefully you enjoyed it, and I'll see you soon.